I've seen a lot of people asking about whether Tesla stock could run up like it did in 2013, where the stock went from 20 to almost 200 in less than 12 months. I've also seen people wonder whether we could be witnessing the beginning of a massive short squeeze, and also drawing comparisons to the Volkswagen short squeeze that happened in 2008, where VW shares increased around 400% in a very short period of time. So I'm going to walk through some simple math to try to determine what situation Tesla is in and whether or not we're looking at a potential short squeeze.
Just based on those numbers, could be the mother of all short squeezes.
Well, I don't think so, but let's take a look and see. I laid out a brief summary here, which sort of covers the differences between what happened in 2013 versus where we're at today. So in 2013, the starting price of the squeeze was about $20 per share, and this was around March 2013. The peak price was in November later that year, almost $200. The stock was up 865%. Here's what I did. I looked at the shares that were short at the time, and I looked at that as a percentage of the stock float. So the number of diluted shares outstanding were 124 million. I'm subtracting Elon's shares as closely held and assuming that the float was 91 million shares. So the short shares as a percentage of the float was about 35%. By the time the shorts had capitulated, they covered their shares down to 21 million in 2013, down about 35% from the peak. And the shorts in this instance in 2019 have covered down to about 28 million. So a similar amount of short covering. Also, I talked about the relevance of days to cover in a different video, but essentially what this means is if all of the shorts wanted to cover at once, how many trading days based on the trading volume? In 2013 it was 2.3 million shares a day, but how many days would it take the shorts to cover their shares? So you can see in 2013 the numbers were much higher, and in 2019 the days to cover is much more reasonable. This puts them in line with some of the larger companies in the US. The takeaway here is that I think it's more fundamentals that are driving the increase in the Tesla share price, and I think that's actually a really good thing. We're going to look at Volkswagen a little bit later, like I said, and when you have a big run-up in a stock for non-technical reasons, it usually means that there's a big drop coming, and I don't think that will happen with Tesla shares. By the way, it's sort of interesting to look at, okay, well, what if I'm totally wrong and there is some type of quick short squeeze? What could the shares go up to? Well, if they went up 865%, that would imply a $1,700 share price. And based on fundamentals, which I'll show you in a minute in combination with Elon Musk's performance targets, I don't think that this price would actually be crazy, which is the funny thing. But anyway, let's go back to 2013 and just consider a few dynamics and what was occurring back then. You can see that the big spike was around May of 2013, and really two things happened. The first is that you can see they actually had their first profitable quarter ever this first quarter. Here were a few other things. Some market observers said that Tesla was spending more on its vehicles but earning less, but as it turned out, Tesla said it was spending less and earning more. So gross margins improved. Does this all sound familiar? And the stock ran. There were also questions and issues and concerns about Tesla's liquidity. They were able to do a convertible bond offering as well as an equity raise at $92 per share, which is obviously a lot less dilutive than their raise would have been had they done it down here around $20 or $30. So you can see the profit spike up. And you can see, and this is very interesting, that the short interest was at its highest right before this big spike, and shorts started to capitulate and started to cover as the price ran. But even after the short interest came down, the stock still had a lot of room to run. Let's also take a look at where we sit today. So this is 2018 to Jan 2020, and you can see that the short interest has peaked right here, basically when the stock hit the lows, and the shorts have been covering as the stock price has been increasing. I wanted to review a couple of things from Tesla's proxy statement. I know that a lot of close followers already know this, but here's my favorite part of the proxy statement. Mr. Musk's base salary reflects the current applicable minimum wage requirements under California law, and he is subject to income taxes based on such salary. Mr. Musk, however, has never accepted and currently does not accept his salary. So he's paying taxes on that salary, but he doesn't even accept it from the company. And I think they actually have to raise it they had to raise it in 2019 from $56,000 to $62,000. But again, he doesn't accept that money from the company. And I think that's great. Here are a couple of details from the first major CEO incentive package, which was conceived in August of 2012. At the time, the stock was trading at around $31 a share, and the incentive plan basically had a 10-year term on it. Elon completed everything, operational milestones and market capitalization milestones, within 5 years. So this was conceived in August 2012. He completed it by early 2017. The only thing that he didn't hit was automotive gross margin performance in excess of 30% for 4 quarters in a row. He didn't do that. But when they gave him that first incentive plan, the market cap was $3 billion. The fully vested market cap would have been $43 billion, and his options were struck at $31 a share. So based on the 5.3 million shares that he received versus the price today, that compensation is worth about $2.4 billion. Let's take a look at the next one, which was written in 2018. So at the time, the stock was trading at around $350. And very importantly, Elon's options are struck at $350 per share. He'll get 20 million shares or options if he hits these operational milestones that the board of directors have set out for him, but he doesn't make any profit if the share is not in excess of $350. So, by the way, a few interesting things. This latest incentive package was approved by 73% of the votes cast by shareholders, and that excludes Kimball or Elon. Some of you, or a lot of you, may be familiar with this chart, but it basically shows the cumulative number of options that vest up to 20 million based on these market cap milestones. And in addition to hitting all 10 market cap milestones, he needs to hit 12 of these 16 operational milestones. So they are revenue and adjusted EBITDA milestones. Let's take a quick look at what the share price would be if he hits all of those milestones. When they wrote this package, the market cap was at 60 billion, and the market cap and the milestones increase in 50 billion increments all the way up to 650 billion. I saw somebody say that the 650 billion implies a $3,500 share price, and they're right based on the current shares today. But I'm going to conservatively assume that these shares move from 184 million all the way up to 250 million shares. So that's extremely conservative. Based on that price, you're looking at a $2,600 share price. Now, don't forget that the last 10-year plan was hit by Elon within 5 years. So if he's able to hit this next plan and the stock gets to 650 billion within the next 5 years, I mean, that's at least a $1,700 stock, and that's if you discount it back to today. If you use the lower share count, it's at least a $2,000 stock. So there's a lot of upside left in the stock, and Elon has a history of blowing through his targets. It's worth taking a look at some interesting charts. So this is Microsoft in 1987. So this is split adjusted, but if you had bought Microsoft here and you'd waited 5 years, your stock basically went from 20 cents all the way up to $1.60, which is 8x. So keep 1991 in mind. And on a chart, here's 1991. So your shares went from that $1.60 to 161. So they 100x'd from there. Apple, same thing. Here's 2003. So the price, again, this is split adjusted, but the price goes from $1.30 all the way up to $6. So you're thinking, oh, my share's 5x'd over, 2 years. Okay, well, keep the $6 in mind and 2005 in mind. So on a chart, 2005 is right around here. The point is that when you look at Tesla from a value perspective as opposed to simply a day-to-day trading perspective, the amount of value that is left to be realized is so significant. There's a terrific article about the day that Volkswagen briefly became the most valuable company in the world. And this happened back in 2008 when their rival Porsche was looking to take the company over. And at the time, there was a very popular thing that was developed by hedge funds called capital structure arbitrage. And it related to taking advantage of the difference in prices between various share classes. So in Europe, something that was very common among publicly traded companies was to have one share class and then a different preferred share class that received dividends and traded freely, but that didn't have any voting rights. And so as a result, there would often be differences and discrepancies in terms of where the ordinary shares traded versus where the preferred or preference shares traded. And so hedge funds took advantage of this basically by going short the stock that was trading at a premium and going long or buying these shares that were trading at a discount and betting on a spread collapsing. Hedge funds made a lot of money doing this, and it was a really profitable trade for a long time. This chart says it was easy money, and you can see the difference between Volkswagen ordinary shares versus the preference shares, sort of that spread blowing out. And the reason that the spread got so high with Volkswagen in particular was, again, because Porsche was attempting to take control of the company and they needed a certain number of shares in order to do that. So they weren't interested in the preference shares, which carried no voting rights. They were only interested in the ordinary shares, and Porsche was buying those. So hedge funds were looking at this dynamic and scratching their heads and saying, well, the spread is so big, if we short it, we'll make all this money. It says here, according to market data, that 12% of all shares were sold short, which is around $10 billion worth. So that's hedge funds setting up their trade. And that 12% number is significant because the volatility of the stock started to increase a lot. And Porsche, again, who's attempting to do this takeover, all of a sudden puts out this press release where they say, due to these dramatic distortions in the financial markets, and they were talking about Volkswagen stock, Porsche, through a combination of buying ordinary shares as well as purchasing options, now control shares representing a total of 74.1% of the entire float. And when you added that to basically a state-held 20%, you're looking at 94.1% of the shares which were tied up and unavailable to borrow. See, when a hedge fund or anybody really shorts a stock, you need to find somebody who's willing to let you borrow that share with the expectation that you can buy it back in the open market and then deliver it back to that person. Hopefully you buy it back at a lower price than where you sold it. So with 12% of the shares outstanding sold short, it was mathematically impossible for every short seller to buy a share and close their position. So it led to this dramatic short squeeze. This chart says 2 to moon, but you can see basically that the share price ran up from 200 to nearly 1,000, and it was created by that technical dynamic. So anyway, this has nothing to do with Tesla whatsoever. It was not fundamentally driven, and I don't think that people should draw any analogs or comparisons. If you're liking these videos, give me a thumbs up. It's great to see you back here. Thanks again so much for watching.